So, hello everyone, a very warm welcome to all of you in our YouTube platform of Ecoholics, especially there to cater the needs of future and present RBI Grade A and Grade B aspirants. Now, in our today's discussion, we had discussed, sorry, in our yesterday discussion, we had discussed the Basel norms. Now, I told you in our yesterday discussion that Basel norms are something that is extremely important not only from the perspective of RBI grade A or grade B, but also from the perspective of other banking level examinations. Because it is a static component, but it is quite important seeing the data it provides. So it provides all kind of you can say the requirement of capital and different buffers that should be having with any financial entity to absorb the liquidity crunches, to absorb any kind of financial shock. So, and whenever we discuss the in finance, when we discuss the banking sector, in economics as well, the banking sector has a prominent, you can say, role. So, in all these scenario, the the healthiness or the healthiness of banking sector and and the regulated entities are extremely important. And what do you understand if I say that this business entity or this particular financial entity or a bank is healthy? It means whatever operations they are doing, they have enough amount of capital, they have enough amount of tools with them to absorb any kind of shock that may arise in the future. That's why we see now even in the human bodies, in humans as well, when we say that this particular person is quite healthy, because we know that this person is having a good amount of health. He is doing workout or whatever he is doing via whatever tools, he is having enough amount of strength with particular that person is having enough amount of strength with him or her, so that he can fight with any kind of diseases or any kind of unhealthy situation that may occur in future. So this the same scenario goes with the banking entities as well. When we'll talk about the healthiness or the robustness of a financial entity, then we'll talk about the various tools that should be there with these entities, so that they can absorb the shock, any kind of shock that may arise in financial scenarios in future. And this is the reason that Basel norms becomes extremely important. Now, in our yesterday discussion, we had a brief discussion that what is the Basel norms, how which is the committee who framed this regulation. Okay. Then why this Basel name came in existence, and we also have a look of Basel 1 and Basel 2. Now in our today's discussion, we will be seeing what is Basel 3 norms, and that is the present and the most important, you can say, that is the most important norms of the Basel Accords. Now just give me a minute, let me present my screen to you people, and then we will go ahead. Okay, so I think the screen must be visible to you people now. Just wait. Yes. So I think the screen must be visible to you now. Trisha, you didn't attend Basel norms. No issues. The live sessions are there available in our channel. You can have a look. It's a only 20 to 30 minutes discussion. You can have a look of that particular thing. Okay, you will get a clear cut idea. Yes, you can continue this class. Obviously, you can continue because the only important thing is the Basel norms 3. Now, if I'll take the example of any movie series, now the only thing required is the background. What is the background? Why Basel norms 3 existed? When there was already Basel 1, when there is already Basel 2, what was the requirement of Basel 3 norms? The earlier video that we had in our yesterday live session, you will get an idea. Okay? Even some basic fundamental things we will be discussing today as well. So don't worry, you can attend this session. Now, Basel norms, Basel Accords, we have discussed this in our yesterday live session, that it is an international banking regulation issued by the Basel Committee on Banking Supervision. So this is a banking regulation, first of all, but it is not getting released by RBI. It is an international banking regulation issued by Basel Committee on Banking Supervision to harmonize banking regulation globally. Then, why the name Basel? Because the committee that just we saw, that this committee, Basel Committee on Banking Supervision, has their location in the office, in the headquarters of Bank for International Settlement, BIS, and the headquarters of BIS is in Basel, Switzerland. So this is the reason this committee has its location in the office of Bank for International Settlement, and from there itself the name Basel came in existence, and that's why we call it Basel Committee on Banking Supervision. Then then we also saw that in the year 1974, first of all, the central banks, the governors of central banks of G10 countries came together, and then they established this committee on banking supervision. Then in 2009 and 2014, in these 2 years, new stakeholders got added. New governors of different central banks joined the, you can say, the committee. And then in the year, and then consecutively in the year, you can say, I think in 1988 Basel 1 come, and then Basel 2 came, and now we are here with the Basel 3. But why Basel 3 requirements was, but what was the requirement of Basel 3 when already Basel 1 and 2 were there? So before that, you will be requiring to have an idea, okay, that Basel 2, after Basel 2, the whole, after Basel 2, we saw an unprecedented event. What was this? What was that unprecedented event? That was global financial crisis of the year 2007. Some people call it 8 and some people call it 9. Okay? So, but it got continued for 2 financial years at least. So that was the global financial crisis that we saw after the Basel 2 norms. And that global financial crisis revealed multiple things, revealed multiple flaws. It revealed multiple flaws of the global financial system. It exposed the weakness in the capital basis of international banks. International banks were not having enough amount of capital with them to sustain in these kind of financial crisis. Then different definition of capital across jurisdictions. Might be US is having different kind of definitions of different kind of capitals required to be there with their financial entities. Might be European Union is having different kind of definitions of capital. Then regulatory adjustment not applied to correct capital levels. Disclosure were often deficient or non-comparable. We saw that in Basel 2, the third pillar was market discipline. In market discipline, what we saw, the transparent and accountable disclosure of data. That was the third pillar of the Basel 2 norms. But what they realized, that disclosures, whatever disclosures they were having, it was not sufficient. It was deficient and are non-comparable. You cannot compare, you wouldn't be able to compare the disclosures of a central bank of US or the central bank of UK. So that was the non-comparability as well as deficiency. Result, what was the result was erosion of public confidence in banks capital ratio. So banking, now see, banking is an area that obviously has a lot of things to do with the having a enough amount of capital basis and other kind of regulatory parameters, but it also works on goodwill. It also works on confidence. Your public, your citizens should be having confidence in their economy, in their banking sector, in their financial entity. It is extremely important to have a public confidence on their system, on their banking entities. So obviously what I said, that the functioning of banking sector is already based on the capital requirements and other kind of prudential and other kind of rules and regulations, but the having the confidence of public is also important. And this capital ratios, this kind of prudential uh, regulating rules not only provides a kind of sufficient basis, capital basis, or sufficient tools with these financial entities to absorb these kind of global financial crisis or any kind of liquidity crunch, but at the same time they also they also be a means for a public to have a confidence on their financial entity, on their banking sector. And now we will see that what are Basel norms 3. So first of all, it got introduced by the in the year 2010. So we saw, just wait. Just wait. Okay, so we saw that in the year 2007, 8, and 9, we had a global financial crisis that was unprecedented in nature. But then in the year 2010, this committee saw everything that happened on a global financial crisis. In a global financial crisis, whatever situations happened, they observed it minutely. Then they introduced the Basel III norms in the year 2010 to address weaknesses revealed by the global financial crisis. Now it was aiming to strengthen the quality and level of banks' capital basis. It introduced stricter disclosure requirements. It defined as comprehensive reforms package to improve regulation, supervision, and risk management. Now, the four key parameters were the capital, leverage, funding, and liquidity. These were the four key parameters, you can say. First of all, the capital requirement. Second of all is leverage ratios, different leverage ratios they introduced. Then the funding, and then the liquidity. These were the four key parameters of the Basel norms 3. Now, what was the capital requirement? What was the capital requirement? So if you see, the minimum capital adequacy ratio should be having 10.5%. Do remember it. Okay? The minimum capital adequacy requirement, the C in a short form we call it CAR. It means capital to risk weighted asset ratio. What was it? 10.5%. 8% of total capital requirement plus 2.5% of capital conservation buffer. That was the requirement, 10.5%. But in the later on in this session only, we will also see that what is. So 10.5%, this is something Basel committee said, but RBI has enhanced it a bit, and they have set bit stricter version of this percentages. We will see at the last slide. In the last slide, we will see that what is the take of RBI on these percentages requirement. Okay? Now, 8% was there total capital requirement. Then we had 2.5% of capital conservation buffer. Okay? Now, based on tier 1 and tier 2 capital, this entire thing was based on tier 1 and tier 2 capital. Additional buffers required was capital conservation buffer 2.5% and counter cyclic buffer of 0 to 2.5% of risk weighted asset. Okay? Then funding and liquidity. What was the basic two things that was there in the funding and liquidity? Then Basel III introduced two key liquidity ratios. What were these two liquidity ratios? The first one was liquidity coverage ratio, LCR. It ensure banks hold enough high quality liquid asset. Okay? So they should be having a high amount of that. This particular ratio said that banks must have high quality liquid assets with them so that they can have enough amount of liquidity with them. It means they should be having that much amount of liquidity that must cover the net cash outflow for 30 days under stress conditions. It means if there is some kind of conditions, bank is not having enough amount of liquidity, okay, then in that case as well, they should be having that much high quality of liquid asset with them so that they can sustain 30 days of cash outflow without any issues. That net stable funding ratio, it promotes long term resilience. Basically, this ratio is all about that banks should be having a stable funding source with them. So even in cases of crisis, in financial crunches, liquidity crisis, or any kind of negative scenario, they should be having a stable funding ratio. It requires bank to maintain a stable funding profile for assets and off balance sheet exposure over 1 year horizon. At least for 180 to 365 days, they should be having this much amount of stable funding profile. Even in case if they are not able to get the stable funding from anywhere, they should be having, in a normal scenario they will be getting funding, there is no such issues. But in case of crisis, in case of crunches, there will be a scenario that it will become difficult for any banking entity to have access of funding, proper funding. In that case, they should be having stable funding profile so that they can sustain their off they can sustain their funding requirement starting from 180 days to 365 days in a longer time of horizon. Then the last thing we will see is the leverage. The leverage is something, now leverage ratio is something that shows a relationship between your debt and equity. Debt and equity. Leverage ratios are something that shows the relationship between your debt and equity. Okay. Now, the Basel norm said that the leverage ratio of all banking entities should be more than 3%, equal to or more than 3%. This is what Basel norms 3 said, that all the banking entities should be having a leverage ratio of equal to or more than 3%. But here again RBI came, then RBI has set a different scenario. Okay? What RBI said, that the foreign entities should be having leverage ratio of more than 4%, and the domestic banks must be having leverage ratio of more than 3.5%. This is what RBI said. Okay? This is nothing to do with the Basel norm said the leverage ratio should be more than or equal to 3%, but RBI said no. The foreign banks working in our country on a wholly owned subsidiary basis or having a subsidiaries in our country must be having the leverage ratio of 4% or more than 4%, or the domestic banks will be having the leverage ratio of more than 3.5%. This is what the RBI said. Now, over here we saw that the capital requirement, the capital adequacy ratio was 10.5%. But this is what RBI said. What RBI said, that the minimum equity tier 1 ratio should be 5.5%. The capital conservation buffer comprised of common equity should be 2.5%. Okay? Then the minimum common equity tier 1 ratio plus capital conservation buffer should be 8%. Additional tier 1 capital they must be having 1.5%. And then if you sum it up from 1 to 4, the minimum tier 1 capital you must be having 7%, including 2% of capital, that is tier 2. This is the tier 2 requirement, this is the tier 1 requirement, and then we had the minimum total capital ratio must be 9%. Okay, this is what RBI is saying, that 9% is the total capital requirement. Okay, 9%. So a bank operating in India will have to abide by the RBI norms. Yes, Tuti. So the banks working in India must be abiding with the RBI norms. Okay? Now see, whatever they say, Basel committee, whatever norms they releases that this is the minimum requirement. Okay? This is the minimum requirement, and individual central banks or stakeholders of that committee can have anything above that requirement. Okay? So this is what they say. So the minimum total capital requirement is 9%. Out of 9%, tier 1 must be having the 7%, and tier 2 must be having the 2% of the 9%. Okay? Out of that 7%, we have different requirements. We have seen it. Now the minimum to, and then we also have 2.5% of capital conservation buffer. And if you sum it up, then you will come across 11.5%. So you saw that over here we had a requirement of 10.5%, but as per RBI norms, you must be having 11.5% of capital as per the Basel 3 norms. Capital adequacy ratio required was 10.5% as per the Basel norm 3. But as per the RBI, it should be 11.5% because RBI always wanted to keep it on a positive side more than the Basel committee requirement. Okay? So do remember these things. The important thing is that you must be remembering is this 4 key parameters, that capital, leverage, funding, and liquidity. These were the 4 capital things, 4 key parameters. What was the capital requirement? 10.5% was there as per what? As per Basel committee, but RBI kept it at 11.5. Leverage was 3%, but RBI said foreign banks will keep it around 4% and 3.5%. This is something the domestic banks will keep. Funding, we saw two kind of ratios uh, they introduced, okay? And then liquidity also, liquidity ratio they had, and we had the net stable funding ratio. These two ratios also came in existence. So these were the fundamental things that these Basel norms introduced, and then RBI and other central banks also set their own parameters over and above the Basel committee recommendation. So this is it for today's live session, and I hope that you people must have got extremely valuable insight. And if you want to download this data for free of cost, then you can visit our app. You can download it from the Google Play Store. And if you are having any kind of queries in regards to the this free content or whatever the paid content we provide, you can reach out to this number over there. Our qualified people will quench each and every queries of you. Whatever queries you will be having, it will be dealt as soon as possible on this number. So if you have any kind of issues, do contact us via this number, and you can download this data for free of cost just by downloading our Ecoholics app from the Google Play Store. From there you can get this app and you can get all these data for free of cost. Then thank you so much for joining today's live session, and now we will be coming up again with our live sessions from Wednesday. Till then, have a great day ahead. Bye.